Hi, my name is Carlos Lopez. I am the president and the executive director of Latino Tax Professionals Association. Today, we're proud to present a brief presentation on Trump's tax plan and how it's going to affect you. We've been getting a lot of calls about this, and it's a very important matter, and hopefully, we'll cover all the major points and to keep you updated. The objective of today's learning path is to explain the Senate and House what they did. They passed the bill December 20th. They're now waiting for the president's signature. It looks like he may sign it at the beginning of the year to avoid some other expenses that don't need to be paid for this year. It's called the PAYGO. And hopefully we'll see what happens very soon. The changes are slated to begin for tax year 2018. 2017 is not affected. So we're going to talk today about what is changing and what is not changing. So most Americans will pay less taxes until 2026. The provisions in the bill will expire on 2025. There are currently 7 tax rates. All of them will be lowered. The standard deduction nearly doubles. However, there are no more personal exemptions. Most tax bills will drop, but then again, this depends on family size, the location that you're in, and the circumstances of each family. The miscellaneous deductions are eliminated. These used to be deductions that were exceeding 2% of the AGI. Some of these deductions are tax preparation fees, unreimbursed employee expenses, and home office expenses. The bill also repeals moving expenses except for qualified military moving expenses. The new bill also eliminates the alimony deduction, and it excludes the alimony received from the income of the recipient. These are for divorce or separations agreements that are executed or modified after December 31st, 2018. I guess this is designed so that we have a year to make sure all of our agreements are in the place we want them to be. Casualty losses may only be deducted from a disaster declared by the president. It also expands the use of 529 accounts. You can now use up to $10,000 in tuition per student who attends a public, private, or religious elementary or secondary school. Now, this is per student only and not per account. Let's talk about tax decreases. It will increase those Americans who owe no taxes from 44% to 47.5%. All individual tax cuts will go away after 2025, according to the current bill, unless, of course, Congress extends it. The tax cuts for families are temporary, as I said. However, the reductions for businesses are permanent. The theory is business needs permanent tax cuts to stay, or else they're going to move. We really want them to come back to the U.S. That's the main purpose of the reductions in taxes for corporations. The corporation tax rate falls from 35% to 21%. This will result in about $1 trillion tax cut over the next 10 years. Theorists are saying the economy will either be very modest or it may surge in growth. Time will tell. Beginning in 2019, there will be no requirement to buy health insurance. There will be no penalty or mandate starting in 2019. The long-term result is possibly 13 million fewer will be covered in 10 years. It cuts government spending by $300 billion. Other changes are planned to prevent insurance costs from rising. The medical deduction floor will be 7.5% for 2018 and 2019, and then it reverts back to 10%. Let's talk about the child tax credit. This affects working class families. There will be a bigger child tax credit. The current child tax credit is $1,000 per child. It increases to $2,000 per child, and it increases eligibility to $400,000 in earnings. Low-income families who don't pay any tax will be eligible up to $1,400 per child. And if a family doesn't qualify for the child tax credit, there will be a family credit of $500 available to these taxpayers. The new law will now allow you to pass to your heirs up to $22 million tax-free. Currently, the law is up to $11 million. The estate tax will remain part of the tax code. However, far fewer families will have to pay this tax. This includes property, stocks, and other assets in the estate. There will be some pass-through company tax deductions. This will be a 20% reduction in taxable income. Most American businesses are pass-through. This means the income is passed through to the owners, and the owners will pay the tax at their level. This includes S corporations, LLCs, partnerships, and sole proprietorships. The theory behind this is small business creates jobs, and with lower taxes, hopefully there will be growth and success in the small business sector of our country. There will be no more corporate alternative minimum tax. This is a big relief to the business community. Right now, it's difficult to reduce your tax bill because the alternative minimum tax makes tax credits disappear when a company or corporation spends money on research and development. They spend money on what's called preferred tax purchases. And right now, there is no incentive for corporations to grow if spending money in areas that they need to results in no tax savings. Far fewer families will have to pay the individual alternative minimum tax. The alternative minimum tax for individuals started in 1969. It prevented the wealthy from tax dodging. However, now it can affect families earning as little as $60,000. The threshold now is $500,000 for individuals and $1 million for married couples. Some couples or individuals earning less than the $500,000 may still have to pay for taking some preferred deductions, but they will pay much less. The mortgage interest deduction gets smaller. Right now, you can currently deduct the mortgage interest of up to $1 million from your primary residence. New loans, there will be a $750,000 cap on the amount of mortgage interest you can deduct on your taxes. SALT, this is a pretty neat acronym. It stands for Sales and Local Taxes. However, what's not neat about it is limited to $10,000. Currently, sales and local taxes are unlimited in the amount you can report on your taxes. However, it could place you into the alternative minimum tax. So this will include state taxes, local taxes, property taxes, state income taxes, and sales tax. Now, we've had several of our clients call us and ask us, should I pay my state taxes early this year? Be sure and talk to your tax advisor before you do that. It may result in a higher preference item, and you may be subject to alternative minimum tax in 2017. So make sure you talk to your tax advisor about paying your property taxes early and any state income tax or estimated taxes early. It could work for you, so I'm not saying don't do it. I'm saying be sure and talk to your tax pro. What's all this going to cost us? They're estimating the final tax bill will cost about $1.46 trillion over the next 10 years. And as you know, this will add to our national debt. So what is not changing? That's the question. So the following are kept in place. The student loan deduction, medical expense deduction, graduate student tuition waivers are kept. Retirement accounts stay the same. Your 401ks, your IRAs, and your Roth IRAs. Charitable contributions stay the same. They will increase from 50% to 60% in some cases. As we all know, death and taxes are the only for sure things in life. These new tax regulations do not become law until signed by the president. The last reform was in 1986. How many times have we had tax laws change since 1986? We will do our best to keep you informed. We ask that you sign up for our free newsletter on our website, latinotaxpro.org. Here are some resources. There's a tax calculator link for you. The tax reform plan is spelled out, and tax training and education is available on our website. If you want a PowerPoint of this presentation, please call us at 866-936-2587, and we will be happy to email you a PowerPoint of this presentation. We want to thank you for attending this. If you have any questions, once again, please call us at 866-936-2587 and visit us on latinotaxpro.org. Thank you.